All right, thank you very much indeed for your attention to the last panel discussion. We now have a solo presentation, and I'm very pleased to introduce Nigel Beck. Nigel is Head of Sustainable Finance and ESG Advisory for Rand Merchant Bank. Nigel leads this Sustainable Finance and ESG Advisory business, and he's pioneered the development of sustainable finance on the African continent, executing several innovative and award-winning products. He's the longest-standing chair of the Equator Principles Steering Committee, leading at the International Chamber of Commerce, Sustainable Trade and Finance, and member of Impact Investing National Task Force. Nigel, I'd like to welcome you up on the stage. Thank you very much indeed, and looking forward to hearing from you.
All right, thank you. Just check how it all works. Perfect. So day 2 of the conference, after lunch, you must all be very keen on ESG, because even I am pretty tired. So we'll try and get through these next 15 minutes quite quickly. I'm going to talk about ESG risk, turning ESG risk into sustainable finance opportunity, essentially talk about ESG in the African context, how it's growing, what's driving the market, feedback that we've got from equity and debt investors around sustainable finance products, how the market's moving, and then finally cap it off with the size of the sustainable finance market in Africa, and 2 specific case studies, one more of a green nature and one more of a social nature. But if we start off looking at kind of ESG trends, what's driving ESG in the market, first of all, there's 3 elements. The first one being is the increased adoption and development of regulation, TCFD, the Task Force on Climate-Related Financial Disclosures. Most of you have heard about that. That's being more widely accepted within the African market. A lot more companies are starting to disclose their climate data in line with TCFD. There's the Principles for Responsible Investment. A lot of indexes, such as the JSC, etc., are coming up with specific guidelines for sustainability reporting. They are also starting to carve out specific sustainable segments. So in other words, sustainable segments where you can issue sustainable finance instruments like green bonds, social bonds, sustainably linked bonds, and the like. And then obviously the increased focus on climate change and carbon. We're starting to see carbon tax. Within South Africa, we've got carbon tax, but we're starting to see that becoming a bit more mainstream throughout the continent as well. Then you've got consumer pressure. A lot of consumers are starting to put their money where their mouth is. They're starting to, using ESG to influence your buying behavior to the extent that there's an issue within a supply chain, they're going to avoid certain companies. And with more information available, consumers are starting to make their choices matter. And then the third element, which is something that I'm going to unpack in a little bit more detail through the kind of debt and equity feedback, is the increased investor kind of appetite for ESG. We are starting to see that kind of manifest itself in outperformance in the market. So if you look at kind of the ESG emerging markets, the MSCI ESG emerging markets versus the MSCI emerging markets, there's outperformance in kind of the ESG leader section of that. Essentially, that outperformance is starting to narrow a bit with what we're seeing happening in Ukraine and the likes, but there's still outperformance in the market. So what that means is, that's kind of cascading its way down into the banking sector. Banks are coming under increased pressure from both kind of shareholders, stakeholders, and activists to improve their screening, very much focused on negative impacts in environmental and climate change. Within RMB, what we've done is we've essentially put together a fully focused and dedicated sustainable finance team to support our clients on their kind of transition and sustainability strategies and journeys. What we also, across the organization, are trying to do is kind of recalibrate our internal frameworks so that essentially the sustainable finance opportunities that we're looking at are appropriately kind of supported by the bank's balance sheet. So essentially it's becoming very much mainstream throughout the organization. Within the African continent, if you speak to investors, what are the most useful sources of kind of ESG information? First of all, I think everybody would agree with that, it's direct engagement with companies. There's increased focus on corporate ESG ratings, and I'm going to touch on that a little bit later, as well as corporate sustainability reports and kind of in-house research being essentially the top 4. Net zero commitments. Throughout Africa, we're starting to see increased net zero commitments. I think most countries now have made net zero commitments by 2050. Some of them a bit kind of more aggressively than others. That's starting to cascade its way down throughout in kind of to the corporate space. A lot of large corporates, specifically in South Africa, have now also made kind of net zero commitments. You've got FirstRand, you've got Discovery, Exara, Sasol, and some of these are fairly large emitters have also made these type of commitments. The benefits of these are essentially managing climate risk for your shareholders without kind of that abrupt disruption to near-term results. Obviously, you get the enhanced reputational benefits as well. But there are implications kind of for this net zero approach. First of all, many of South Africa and Africa's top trading partners have made these net zero commitments. Many developed market customers are requiring essentially science-based targets as a condition of trade. So it's becoming more and more onerous to essentially trade into kind of the developed markets if you are just making a commitment without a science-based target. And also it's important to understand that if you make a net zero commitment, it can include scope 1, 2, and 3 emissions, and your scope 3 emissions includes your supply chain. So within the African space, to the extent that you've got a supply chain within Africa that's supplying into Europe, you need to make sure that your supply chain is also net zero. And to the extent that you're a corporate within Africa that has a supply chain and you've made a commitment, you also need to make sure that that's net zero as well. So it's becoming very much more mainstream throughout the continent. So if we kind of touch on the debt and equity feedback, we've done a number of kind of surveys. We've had a lot of engagements with equity investors to start off with. And their feedback is that obviously the approach to ESG needs to be fully integrated. They've fully integrated that into their investment decision making. Most of them don't have specific kind of ESG equity funds, but they see it as kind of mainstream in the way they look at things. They've got this very kind of proactive engagement, so essentially responsible stewardship rather than outright exit. So they would rather engage with a company to the extent that it's not doing something that they feel comfortable with than rather outright exit it. And also we're seeing varying levels of sophistication across the market. There's a very strong focus on targets as well. So, as I mentioned earlier, kind of confirming, and making net zero commitments is not enough. There's a need to look at kind of science-based targets below those as well. So net zero, science-based targets, and then also look at kind of targets across the kind of short, medium, and long term. And there's a very strong push to align reporting to TCFD. So your climate reporting to become more and more aligned to TCFD, and obviously that makes it a lot easier for investors because you can compare apples with apples. Also, interestingly enough, we've seen a strong alignment of executive remuneration to kind of ESG kind of KPIs. 80% of the JSE, or 80% of the companies listed on the JSE, have linked their exec kind of remuneration to ESG targets. Most of these are largely short-term targets. Some of them have also included some long-term targets, and they predominantly focus on climate change, black economic empowerment, and then quite often gender equality as well. ESG ratings agencies, so for those of you who don't know the ESG ratings agencies, that's the likes of MSCI, ISS ESG, Sustainalytics and the like. The coverage across the African continent is quite limited, although it's getting better. I think there's stronger focus in South Africa, but a lot of the other countries in Africa, we don't see good coverage. There's obviously great disparity between the different vendors. There's different methodologies. The scores are not always consistent. And I think what we are starting to see is the S's becoming more and more relevant in the African space. And I think that's quite important as well. So the weight of the S is becoming more and more important. On the debt, investor feedback, working on a number of different bonds across the continent and obviously engaging with the debt investors. 67% of the debt investors have bid on a sustainable finance product. The majority of those, and they feel most comfortable with, I guess, is a green bond. I think the main reason they feel comfortable with a green bond is because there's been more of them in the market. They're more familiar with that specific instrument. We have put social bonds in the market, and they've also been very well received. And there's a strong interest and appetite for transition bonds as well. The deterrents to investing in sustainable finance products are quite often the tight pricing. Quite often they're very highly oversubscribed, so there's very tight pricing, and the lack of clear kind of these ESG or climate mandates. I think ESG and climate mandates are things that are going to come into the future, and then we're going to see increased focus on these type of products. Then if you look at sustainability-linked bonds, and the feedback coming from most of the investors is that there should be a kind of a pricing step-up of up to about 10 bips. So the way we structured it within Africa is not just a penalty. Most European sustainability-linked bonds only have a penalty. We've actually included kind of a step up of 10 bips. Investor feedback is that there should be kind of asymmetric step up, step down. So in other words, if you're going up by 10 bips, you might go down by 5 bips, but there does need to be some type of penalty included as well as kind of the step up. Obviously, there needs to be a strong focus on kind of KPIs. They need to be ambitious enough, so you need to look at historical data of a company. You need to look at their projected forecasts. You need to benchmark it against industry peers, locally and internationally as well, and there's a stronger focus on that. There's also a very strong focus on reporting and trying to understand the impact reporting of these instruments, and I'm going to touch a little bit on that when I go through the green bond. If we look at the markets, so the chart on the top left-hand side is the global sustainable finance market. You can obviously see there's kind of exponential growth. It's got a CAGR of 50%. In 2021, it was $1.7 trillion of sustainable finance, which is a very, very, very large market. And as you can see, by the different colors of the bars, there's a diversity of different types of products. Within the African market, which is the chart at the bottom, first of all, it's a much, much smaller market. In 2021, we did 34 billion rand, which is about 0.1% of the market. So at the moment, within South Africa and Africa, we're not capturing our fair share of the sustainable finance market. We have started a little bit later than the rest of the world, but you can see that there's kind of this exponential growth as well. The CAGR in the South African market is over 100%, and if you can see what we've done already this year, we'll have done more than 2021, probably within the next month or so. On the right-hand side is a couple of creds, which I'm not going to get into because I'm going to talk a bit through the two case studies. So the two case studies that I'm going to quickly touch on, the first one is the FNB Namibia Green Bond. Obviously a green bond, it was issued into the first RAND Sustainable Bond Framework, which had a second-party opinion from Sustainalytics. This bond was specifically used for use of proceeds across renewable energy and green buildings, so IFC EDGE certified green buildings, linked to obviously having this kind of impact reporting that I'm talking about, so the number of green buildings funded, the total square meters of green buildings, total installed capacity of megawatts, and essentially the estimated annual CO2 equivalent emissions reduction or avoidance. So very quantitative around what the potential impact is. It was 353 million Namibian dollars. It was almost 6 times oversubscribed, and it had, I think something north of around 13 local investors invested in it, and obviously it priced very tightly towards the bottom end of the guidelines. It was the second green bond of its type in Namibia. The second product is essentially more of a social flavor. It was Barloworld's inaugural gender-linked bond, which was issued probably about a month or 2 months ago. RMB acted as kind of the range and sustainability coordinator on this one. This also had a sustainably linked bond framework, which essentially had a kind of a second-party opinion as well. It was linked to the ICMA sustainability linked bond principles and was issued into the sustainability segment on the JSE. It had specific kind of themes linked to gender diversity in leadership and kind of growing black women companies in the supply chain of Barloworld. There were specific baseline scores of around 44% moving up to 50%, and then kind of, I think, 12-13% moving up to 15% as well. It was also very well received in the market. It was 1.5 times oversubscribed, 12 investors, and priced very, very tightly as well at the bottom end of the guidelines as well. So I think what I'm trying to explain here is there's a massive opportunity within the African market. We're just starting to realize that we're playing catch up with the rest of the world. There's a lot of runway still ahead. There's low-hanging fruit, but I think there's a lot of innovation coming through in the sustainable finance field, looking at gender-linked bonds. But I think even beyond that as well, what we're starting to look at is specific carbon instruments, landscape financing, and a whole lot of other instruments. So within the African space, there's an ability for us to look at climate, green, as well as the social element, and it's a particularly exciting space to be in. Thanks very much.